Okay, thank you. So, yeah, as Victoria said, what I thought I would do is just spend a few minutes giving you a little bit of an overview of where the economy is. Don't worry, this is not going to be a COVID lecture, and nor am I going to make any predictions for what the future might look like, because I think if you were to talk to every economist, they would have a slightly different view. But I just want to give everyone a sort of picture of the scene that we've seen over the last few months and what this next few months might look like, and then a few pointers as to the sort of things that companies are thinking about and planning, and then hand over to Richelle, who'll go into a bit more of the detail about thinking about how you might want to position for the next fundraise or whatever it may look like. So, where are we as we sit here today? We had a first quarter of this calendar year where GDP contracted by just over 2%. January and February looked okay, but then certainly as March, when COVID hit and lockdown started happening, activities certainly started declining. And that decline in quarter one was actually slightly higher than the largest quarterly fall we saw in the last recession in 2007, 2008, just to put things in perspective. Recession, for those economists out there, defined as 2 successive quarters of a decline in GDP. And so we are very certainly going to be seeing a recession once the figures for June are revealed. Just this morning, some data out that suggests that the economy between February and May contracted by 19%. That was slightly better than the 20% that was the 3 months to April. So some signs of a little bit of a recovery, but many economists saying this morning they thought it might be better. But remember, back to May, lockdown very much still in place, and actually a number of businesses not able to function at all. So May still relatively subdued activity. Anecdotal evidence for June would suggest some signs of a recovery, certainly from those lockdown days in April and May. And that raises a scenario of a very deep recession that will be revealed when the June figures come out, but potentially a short-lived recession. And I'll come on to talk a little bit about what that sort of recovery might look like in due course. So over the last couple of weeks, as we've seen lockdowns starting to be eased and certain sectors starting to be able to function again, we now have somewhere around 90% of businesses in the UK that are operating in some form. Certainly not at full capacity in many industries, but operating in some form. Talking to a number of my retail and consumer businesses over the last couple of weeks, they reported what they would describe as an initial surge in demand as they reopened their physical premises, and probably better than their expectations in those first few days. And a few potential reasons for that. One could be none of us have been going anywhere for the last few weeks. We haven't been spending money on commuting. We haven't been spending money on those lunches at Pret or wherever, or our daily coffee fix. So actually, when a number of us have looked at our bank balances, it's probably been slightly more healthy than it may otherwise have been. Sweeping generalisation there. And certainly as those shops reopened, there was a bit of a feeling of people, just a sense of relief, maybe a bit of feel good, the ability to do something that felt a little bit like normal life. And so that demand certainly saw through in those first few days. And probably, again, anecdotally, somewhere like a 10% uplift in activity just from the shops reopening. That sort of initial few days certainly then sort of peaked a little bit and came off a little bit as that initial sort of excitement waned. But certainly I think most retailers reporting sales that are slightly better than I think what they foresaw, albeit most retailers were pretty pessimistic about what that reopening might look like. So I think we are getting to that point where most economists have called the bottom. April certainly looks like it would have been the month with the least activity. And as lockdown eases, that activity starting to pick up again. So the focus has turned really to what shape the recovery would look like and what businesses should be thinking about in terms of that recovery. When you look at the Bank of England's forecasts for the full year for 2020, they're forecasting somewhere between a 10% and a 14% decline in GDP, and they're talking about a V-shaped recovery. Our own economists at PwC are slightly more optimistic than that, so 8% in the best case, 12% decline in a worst case, and this very much depends, on what shape that recovery takes. And, for certain sectors, the recovery will be much slower than for other sectors potentially. And just a little sort of fly in the ointment, dark cloud on the horizon. When we look forward to the autumn time, as the government's furlough scheme starts coming to an end, as mortgage holidays for individuals start coming to an end, and for many businesses, that September rent roll is going to be a much more challenging conversation with landlords. Thinking back to the last couple of rent rolls, so March, lockdown just starting to hit, so conversations with landlords around, look, we're going to be closed, we're not going to pay this quarter's rent. June, for many people, just starting to reopen. So again, a conversation with the landlords, and landlords not able legally to do anything about that situation. Whereas looking forward to September, as businesses have reopened, I think those rent conversations are going to be much more challenging. So the autumn looks like it could be another potential difficult point for the economy. And this is all assuming no significant second wave, second spike, second lockdown that is anything more than localised, as we've seen in Leicester over the last few days. So that recovery, as say, Bank of England on a V, other economists, I've even heard the Nike tick described. I think most people in a view that certainly the second half of 2020, much better than the first, clearly when we've had lockdown, but a gradual recovery through the rest of 2020 after this initial sort of pickup with businesses reopening, and that's seeing through into 2021. So even with that sort of bounce back that we're expecting in this second half of the year, probably by the end of the year, we will still have GDP in a place where it is lower than it was before we went into this COVID period. So how are businesses responding, and how can businesses plan for that and think about their own futures? Well, it's certainly not all doom and gloom. And while I'm not about to paint an overly rosy picture, nor will I paint an overly pessimistic picture here, because it's in times like this and in previous recessions where entrepreneurs have typically really made their mark and prepared their businesses for that next stage of growth. So a couple of things to think about. Cash. Cash is critical in this cycle, and thinking about very carefully where you want to prioritize investment and spend in your business, and cost, and managing that cost where you can is absolutely critical. Because as things recover, it is cash that businesses need, whether it's to fund working capital, whether it's to fund expansion, whether it's to fund M&A. It's cash that helps that. So that's absolutely critical. And been quite interesting observing listed companies over these last few months. So listed companies have raised in the UK £21 billion in the first half of this year. And that's the busiest first half for fundraising since the first half of 2009. Now, there are a number of factors for that. One is to protect balance sheets through a COVID period where there's been a partial or full shutdown. But there is certainly a suggestion that listed companies have used that market opportunity also to build their balance sheet for future growth, both organic growth themselves, but also to drive M&A activity. And one of the things that's been very prevalent talking to private equity funds and venture capitalists over the last few weeks is that they all have cash to spend. They were not in a rush to spend that cash as COVID hit, because the first businesses that were crying out for money were typically the ones that were relatively weak already, were potentially in some form of distress already. And so any funds into those businesses was probably just prolonging the inevitable for those. But certainly as we're coming out into this next phase, there will be some very good businesses with a very sound business model that need cash to fund that expansion. And that's where the private equity funds and the venture capitalists are really interested in focusing their attention, because they see this next 12, 18 months as a really good opportunity for them to invest in businesses with good management teams, invest in businesses with a sound business plan and with a real opportunity for growth.
Okay, thanks, Victoria. Thanks, Arif. I think that's a good sort of backdrop for what we're talking about next. I've been I've been talking to 5 particular entrepreneurs, very, very different entrepreneurs over the last 4 months. Really sort of, I suppose, learning from them as well as sort of trying to support them through this. Very, very, very different businesses in very different sectors, from hospitality to property tech, online fashion, wearable tech up to med tech, which is obviously a very interesting area at the moment. And I think it's sort of safe to say all these businesses, they come from actually 5 different generations. You know, entrepreneurs come from all different areas, but they're actually seeing a real sort of renewed sort of energy for what they do, and have adapted like entrepreneurs do to the situation to really sort of make those opportunities into much clearer opportunities, more scalable opportunities, and actually, you know, use this opportunity to really craft their story, make it much more compelling, because let's face it, we've got some big issues and big opportunities and challenges to meet. So I echo some of what Arif said. Deals are still happening, reflecting on perhaps a little bit slower than before. I mean, a lot of things were stalled, not only because deals were having to be done remotely, but actually sort of working through the impacts of COVID, which was absolutely understandable on all levels. I think there is a renewed sort of focus on security and risk for obvious reasons in certain sectors, but I think the sort of choice that's now available in terms of finance makes this a really interesting place for us, for entrepreneurs to be in. There's been some really big sort of stars, I suppose, in terms of government sort of initiatives in the last 3 months, which are, you know, if you haven't looked at, you must. So starting with the bounce back loans, I've seen a number of businesses really benefit from these, a really lucrative, easily accessible way of getting hold of money to help you deal with what you're facing, but also investing your startup plans. Very favourable rates, obviously, are free for the first 12 months and then going to sort of 2.5% interest rate after that. So it's much more competitive than some of the startup loans we've ever seen. Probably worth we won't go through sort of C-bills, you'll probably be more familiar with that, but certainly if you're looking to raise more than sort of 50k or need more than 50,000, then you'll be moved up into the C-bills sort of area, so that's really important. The Future Fund is probably also worth mentioning for those of you who are at that sort of commercialization or sort of R&D stage. So really, if you've got something that is exciting but needs more development, then the Future Fund, which is a scheme sort of developed by Innovate UK, which is also a real lifeline for a lot of companies at the moment, to really think about how they sort of invest in those ideas and keep that R&D flowing. Really important to sort of keep that going. We're pretty sure that this recovery is going to be partly based on the quality of our startups coming through, you know, from today. So actions now will make a huge difference to the shape of the recovery. I did say we talk a little bit about the sort of landscape at the moment and what might have changed. We talked about the obvious things in terms of deals being done remotely, which does put a lot of stress on some of the systems and certainly puts more sort of pressure on you as entrepreneurs to be prepared. And that sort of starts from the tiny things in terms of, you know, really making sure that you're organized in terms of the information you're going to be passing over to the investors, how you sort of shape that proposal in the first place, being very, very honest about how you're sort of dealing with COVID and the impacts it might have had. So I think all that needs to be sort of taken on board as an entrepreneur. We know it's difficult, but it's even more important right now to get yourself organized in terms of that sort of finance piece, as well as your story. Many of you will know the sort of Simon Sinek writer, talker, author, follower. He said some wonderful things about sort of the why of your business, and I think that really resonates with a lot of entrepreneurs anyway, even more so in sort of COVID times. And actually, I just say absolutely craft your story, talk about the why, but you must talk about the how. You know, I think this is sort of the difference in sort of perspectives in terms of the excited and passionate entrepreneur thinking about, you know, what is possible, and there is a lot that's possible right now, which is really exciting, but actually about the how you're going to build that business, what you're going to use that money for, and how you're going to build that into a scalable business that they can back. So also to keeping in mind that investors are looking to get a return on their investment. They have a portfolio of companies most likely, and you're trying to find a sort of win-win position where, you know, they can put that money in with an acceptable level of risk, and you're able to sort of build your business with the expertise around you to do that successfully. So one of the areas I know we're going to cover today, and probably most effectively done in questions, is sort of the breadth of finance that you're able to, the breadth of finance, and also the types of investors that you're able to approach and how to do that. It's a very big question, and actually, I hate to say it, but it does depend a lot on where you are in the business, what you need the money for, how much you need it for, what sector you're in, where you're actually, your competency as a management team, what level of competence you have in the team and what you need. So there's lots of factors that go into, designing your funding strategy, and that's what I'll call it. And your funding strategy could be made up of a mixture of sort of these options. Crudely put, we talk about sort of pre-seed funding, and then we talk about seed funding. So essentially we're talking about the startup side of your business, and then as you go in from idea to commercialization, to actually turning that into something that is in the market, actually making a revenue and thinking about the investment it needs to move forward. So there's a whole host of range of options that you've got. I think the first sort of question you should ask yourself is that sort of balance of debt and equity. So if you're really sort of looking at the sort of equity route, thinking very carefully about, what do you expect in terms of your control of that business, and also what you expect in terms of, that type of investor, how hands-on you want them and how involved you want them in that business, or good things to think about. In terms of debt, again, a huge amount of options available for you, not just the traditional banks, but what we now sort of term as alternative lenders, which are not so alternative now because it's actually, quite frankly, a burgeoning industry in itself. Peer-to-peer lending, crowdfunding, all very, very good options for different situations. So my advice in all of this and all these options is sort of sitting down and spending time thinking about what your funding strategy will be, depending on what you need, where you are, and where you're going. So happy to get into more of the detail of that. I'd sort of keep in mind that this is a partnership. When you're sort of working with your funders, don't think of it as them and us. Be very clear about what you need as an entrepreneur, and build, your story around that. Think about your management team, the level of return that they will expect, looking at what they've funded in the past. Talk to the people that they've invested in, get a first-hand account of how they work and how they operate. Think about your plans for scalability and potentially their appetite for sort of follow-on funding once you've had the first round. And then also I think the last thing I wanted to just talk about was, is almost a COVID test. How have you responded and actually prepared yourself and responded and pivoted, or whatever you want to call it? How have you reacted to this situation we find ourselves in? And that tells you and the investors a lot about how you're going to be performing and how you're going to be operating in the future.
Morning, everybody. Thank you very much for joining this session. It's a really great turnout. Victoria, well done. I think this is a great start to your series of events. So a little bit of a story from me, and just the how it all started, the process, and where we ended up. And I'll be as quick as I can because there's a lot to talk about. But as a business, we had been formed out of a management buyout. Actually, we were part of another company originally called Pan Credit. In fact, we actually just moved to another building on the same business park when we did the management buyout. It was a very simple transaction in that stage. In fact, really, it was like having a seed round. So at the time, I didn't know that's what it was called. But essentially, we had known parties that had helped us to invest, as we did ourselves, into buying the IP from the company that we were part of. So known parties that are involved in that business, myself and CTO and our then finance director, bought the business and moved it into the building which we're now in. 5 years, we scaled and grew the business. We got to about 35 people, and we were at a tipping point where we actually needed to raise some growth capital to be able to do some international expansion and accelerate our business, because we had that proven base of customers. But we also had those original seed investors. Like I said, we never called them that. They were just people that we knew that had helped us to buy the IP, who wanted to take some cash out. They'd retired, they were at a particular stage in their life, and actually it was just a good opportunity for us to go to the market and do two things: help to raise some cash to cash out those shareholders so that we as a management team could hold more of the business, but also bring in some new investors and some growth capital to scale the business up. Now, I didn't know any of those words. In fact, scaling as a language and a methodology was all completely new to me. I was just running the business with my team, growing a team, head down, knowing what I knew about my product. So finance was completely new to me, and fundraising was not something I'd ever done, and certainly nothing that I knew anything about. And actually, a lot of the terminology that you've heard from Arif and Richelle today was completely foreign. I don't be put off by that, because what I discovered, we went on a PwC scale-up program. We were invited to join that. At the time, I thought, well, this would be a great way to learn from peers. But actually what it did do is it opened my mind up to the opportunity for going into the market and seeing how to raise finance without being an expert. There's lots of advisors, lots of support and help out there. In fact, I met Richelle via the PwC programme. In fact, she was one of the first people that sort of sat me down and went, look, you can do this. You know, there's lots of people I can introduce you to, will help you on that journey. So I didn't really know anything. I didn't understand the language. And for me, it was a step-by-step learning. And I think I liken it to being a parent. I have two children, Natalie and Henry. They're 13 and 11. Never been a parent before. And I definitely learned as I went along how to be a parent. I'm still learning, and I'm definitely still not getting it right. And I don't think that's any different when you're raising investment as a leader who's never done that before. So the thing you do, like you do as a parent, is you go out and speak to people about, you know, how do I do this? How do I do that? Where do I go to understand, learn, read, and speak to my peer group? And certainly that's what I did. I met lots of people. I had lots of coffees. I had lots of conversations. I created a network around me of people that had been there and done it, or certainly new people that could give me that support. And this was all free time, cups of coffee. In fact, Victoria Tomlinson ran an event called Next Up Conference, the first one, where I met a whole series of advisors and people that had been there and were immersed in that kind of community that could give me this the quick coffee conversation to just help me to get the confidence to kind of really go for it. And I think when you commit to a process, you don't have to know everything. You just need to know that the outcome, the thing that you want to achieve, where you're heading. Learning the steps of the process to get you there is something you can learn as you go, just like being a parent, really. So I committed to the process. I believed that I had a group of people around me I could pick up the phone to and go, don't really understand this, what does it mean? Who can help me with this conversation? And certainly that's what happened. The process started by going out and finding an advisor that could help us to manage the process. Somebody that, in this case, it was Grant Thornton. Richelle has been working with Grant Thornton for many years, and she made some introductions to people and we liked them. It's a lot about relationship, this, you know, do you like the people you're going to be working with? You're going to be working closely with them for a long time. We did see lots of other advisors, but we went with Grant Thornton. And they helped us to manage a process which end-to-end was about going to market with an investable plan, and they helped us to shape that plan and forecast. Identifying potential investors, which could be right for us based on what we were looking to raise, the value of the raise, as well as what we were looking from an investor from a support and a relationship point of view. So were they a good fit for us as a management team? So getting that information out to the market to make sure we had a short list of people that could invest in us, but also would fit us as a business was important, and they did a great job of that. And then running a process, competitive process, to make sure that we had lots of people that were excited by the opportunity to come and invest in us, but making sure that that competitive process enabled us to have the best terms around that, essentially that investment for us as a business. So they run a tight timeline. We did lots of pitches. They coached us and mentored us before we went and did those pitches. They helped us to think through how we position things and also answer questions, and sort of went through some dummy runs of the questions you would expect an investor to ask and how you might want to respond to those. So that support, that mentoring, that advice along the way, learning about the things you need at the time you need them was really, really important. And actually was probably the success factor in us getting to a final closing round. So closing a fundraise is one of those, you kind of build up and you put a lot of energy into something and then it suddenly happens and you're like, okay, we're here now, what next? It is a bit like having two jobs where you're running a fundraising process, so you do need that support around you. It is intense, but actually you learn so much, and it really challenges you to think about what you want as an individual, but also what you can achieve as a business, which I think is really good rigor. And the due diligence process they take you through really enables you to shore up the business, to understand and identify any risks that you have. So I think it's really good for you as a person, but also for the organisation of the business itself to go through that. So when we closed the round, the next thing was, hey, we've got some new board members, some new directors, some new people around the table. We've also got people that are exiting the business, and you know, you're managing some new relationships, and like anything, you're sort of going through a process of getting to know each other. So for us, since we raised the money in November, and we have a new board, we have a new chairman, we have two new investors around the table, and we've had COVID, which has meant we've had to sort of manage that getting to know each other remotely has just meant a change of practice and discipline. So more regular and frequent communications, making sure we're checking in with one another so that we can understand, make sure there's no breakdown in communication, because when you're getting to know anybody, it's always about, do we understand what each other's saying and how we're saying it, and are we giving each other the information in a way that can enable that. And actually that's worked really well. In fact, frequency of communication with our new board has enabled us to build that relationship quickly and in small pieces, and it's been a great experience. They've been incredibly supportive, and even in these really uncertain times when we've brought investment in for growth, and actually that growth might look different in the next 6 to 18 months because of the nature of our economy, they have been very brought into reforecasting, looking at how the business might need to change focus and reshape what they're doing for us to be able to accelerate out of the other side. So very supportive, really helped us with that process of rethinking. So the business they backed and the plan they backed has changed a little bit, but not fundamentally. But the focus and the direction of where we're heading has become refined based on the situation we find ourselves in. And actually, you need investors along with you that are prepared to kind of rethink with you as an entrepreneur when things change. So that relationship and finding a partner that you feel you can have a good conversation with, a good open and honest relationship with is as important as the investment itself. So I think the one piece of advice I would give anybody that's considering going on this journey is, don't try and understand it before you get into it. Focus on the end and identify those peers around you that can be those advisors and mentors and supporters through the process, because choosing that right partner for investment and making sure that they work with you and work with you well, like I say, is as important as the cash itself. And certainly for us, the outcome's been really positive. So as you can see, we're in a busy office. There's quite a bit of noise in the background. We're in the open space here, but you know, we're heading off in a really positive direction. And whilst things are not looking 100% certain out there, I think as entrepreneurs we have the opportunity to identify new opportunities and really go for them and get behind them and be ambitious. So that's what we're doing. And if anybody's got any questions for me or wants to know a bit more about how we've gone about this or who we work with or want some introductions, then please don't hesitate to reach out. LinkedIn's the best way for me. All right, thank you, Victoria. I'll leave it there. That's okay.